So what problems do US expats face? What we're seeing is that US banks and investment houses just don't want to deal with US expats. They're closing US expats' accounts and refusing to allow them to trade or manage those investments once they've left the US. Now, there are many reasons that they're giving as to why they're closing these accounts or why they're restricting them from trading, but the predominant ones that we see is that it tends to be a lack of US address. Now, technically speaking, these US banks can service expats, but the increased compliance and regulatory burdens means that they often just don't want to. And many expats can find their accounts restricted or even closed. Now, when your account's restricted from trading, you lose the ability to rebalance and modify your existing investments. And that's essentially tying your hands behind your back when it comes to investing, as you're unable to react to market conditions or circumstances. Now, closing your account is even worse because it stops your investments from being able to grow. And essentially it means that your investments are sold at a time not chosen by you. And unless you're extremely lucky, you're not going to have your investments sold at the time of your preference. When we look at retirement accounts, in the case of 401ks, traditional IRAs, these problems also apply. We're seeing more and more retirement account providers closing or restricting access to US expat accounts. When providers take actions against their US expat clients, the best case scenario for them is that they're restricted from trading and rebalancing their portfolio. And the worst case is that US expats are either asked to find a new custodian or see their accounts closed. Now let's have a look at the best case scenario in a little bit more detail. And to understand why having your access to your account restricted from trading is such a bad thing to happen, we first have to talk a little bit about risk. Now, what is risk when it comes to investment? Well, risk really refers to what's known as volatility of price or short to medium term unpredictability. So when we talk about an asset having high risk, that means in the short term, the price is going to be very unpredictable or very volatile. It's going to jump up and down repeatedly. Now, the other thing that we need to understand is the relationship between risk and reward. Because predictability is a benefit, unpredictable assets are often undervalued. And as such, by increasing risk or increasing unpredictability, in the long term, you as an individual investor have a much higher potential to experience high long-term growth in your portfolio. So the traditional understanding is as we increase risk or unpredictability, we increase our long-term gains, although of course nothing is guaranteed. So where does this come in with retirement planning? Well, when we are young and when we're working, all of our funds in our retirement account, we don't need those assets to be predictable in price because we're not selling them until retirement. So they can jump up and down as much as we want, and we don't mind because we're happy with that performance in the short term because we understand that in the long term, they're likely to grow far higher. However, when we get to retirement, you stop earning money and your retirement withdrawals become your new income source. In this circumstance, predictability is really important because you want to be able to have a predictable income. You want to know how much money you're going to get on a monthly basis or a yearly basis so you can plan around it. Imagining having a job where your employer randomly gives you a different amount of money every month, that would make life so much harder. So for that reason, as we get closer to retirement, we want to have more predictability in our portfolio. Not to mention that, but having highly volatile investments as we get closer to retirement runs the risk that there could be a large, sharp downturn in the market, a correction, or even, God forbid, a crash, and that could severely reduce your retirement income for the remainder of your retirement. So we always recommend that it's important when you are planning for retirement to start out with high risk investments, according to your risk profile and comfortability. And as you get closer towards retirement, to then de-risk these, when we need to start favouring predictability. So when a retirement plan is restricted from trading, you are losing one of the most fundamental tools in order to build a retirement. Now that's the best case scenario. Let's talk about the worst case scenario. And that's being asked to find a new custodian or having your account closed. If you are asked to find a new custodian, you are normally given a fixed amount of time to do so. And as a US expat, that's going to be very hard for you. Because for the exact same reasons your old custodians are asking you to find a new one, any new ones you approach in the US are unlikely to want you either. Failure to find a new custodian means that the funds will be paid out directly to you. And this has some serious tax consequences, because that will be treated as income, and you can have in excess of 45% tax penalties on that. And then on top of that, if you are under the age of 59.5 years old, you're going to have early access penalties of an additional 10% worth of tax. So the worst case scenario is that, let's suppose you're an expat outside the US in pretty much any country in the world, and you use the 60-day rollover rule to have your retirement accounts paid out to your bank account, whether that's in the US or locally. And while the US government might accept, or will accept, putting that back into a retirement account within the 60-day period shouldn't generate any tax liability for you, that is very unlikely to be the case in your local country of residency. They will just see income, and that's income they can tax. So the worst case scenario is you do find a new custodian, but you use a 60-day rollover rule to transfer it to your accounts and then into a new account. So you have to pay tax on that in your local country of residency, and then you'll still have to pay tax when you withdraw it from the US in retirement, because it's in a retirement account. So it will be an income generating event when you take it out the second time. But regardless of whether you have the best case scenario when the provider takes action against you or the worst case scenario, there are additional considerations that you need to make. One, not having a US bank account when you come to retire can make withdrawing money from your retirement accounts a very complicated procedure. Certain retirement administrators currently refuse to pay income from a US retirement account into an international bank account. So retaining a US address with your providers in order to try and sidestep these issues by saying that you're still in the US to them can lead to significant problems. One, you are misrepresenting your country of residency to a regulated authority. Two, cash flow issues can arise because they will pay out your pension net of withholding tax, and then you will have to pay tax on those withdrawals in your local country of residency, so you're essentially paying tax twice. You will be able to claim that tax back through foreign tax credits, but it does mean that for a certain period you'll have paid too much tax and have less cash. But I think the major thing to think about is that that often is unlikely to work, just because simply by filing a tax return as a US expat, which everyone is required to do, many providers are updated by the IRS as to your new country of residency. So it's not been an option for most people. Now we've covered assets in the US, let's just have a look at a quick summary of this. Having an investment account restricted from trading really impact your ability to react to market events and manage your portfolio effectively. Having an investment account closed means that it just stops growing, and chances are it will be closed and your assets will be sold at a time you do not want it to be sold. Consider the fact that stock prices globally fell considerably in 2022, and let's suppose accounts were closed in 2022. Well, I can tell you that most of those accounts will be unhappy that they were sold at such low prices. Now, retirement accounts are probably more serious because not being able to manage risk in a retirement account, if it's restricted from trading, loses one of the most fundamentally important tools when it comes to retirement planning. Either you will be in a situation where you've got far too high risk investments as you approach retirement, and your portfolio will be very unpredictable, and you will not be able to have a predictable income. Or if that's not the case, that will mean that your retirement account has been completely far too under-risked and hasn't grown enough in the years leading up to that. And the worst option for retirement accounts is, of course, having to find a new custodian or having them closed, because that can lead to severe tax penalties if you do it wrong. But now let's have a look at non-US based investments. Now this is probably something that most people watching are more familiar with. If any of you have tried to open a bank account outside the US, you're always asked if you're a US citizen. And in this section, I get to explain why that's the case. And the two major hurdles affecting US expats when it comes to investing are the Foreign Account Tax Compliance Act and Passive Foreign Investment Companies, or PFICs. Now let's just have a look at FATCA, or the Foreign Account Tax Compliance Act. This was enacted under the HIRE Act in 2010. It really was just created as a way of trying to target tax evasion, and all it does is it requires US citizens to file annual reports on any foreign account holdings. That doesn't really seem to be that much of an issue if you think about it, but it's had some major unintended consequences for US expats. Individually, the consequences for failing to do this are fines between $10,000 and $50,000, and it only really applies to US expats who have either $200,000 net asset value at the end of the year, or at any one point during that year having more than $300,000 worth of net asset value. However, those aren't the problems for US expats. The problems really stem from the effect it has on international banks. Now, international banks, so the local banks that you might be trying to sign up to as a US expat, are required to report all of their US connected individuals to the IRS. Now, their fines are very significant because failure to be compliant with FATCA can result in an additional 30% withholding tax on all US sourced income. And for most international banks, that is a huge figure because so many of them do significant business in the US. And the IRS reported in 2022 that over 400,000 international entities were fully compliant with FATCA. So what's the problem? Well, the problem is that there's more than one way to be compliant with FATCA. The first is to report all of your US connected individuals to the IRS and do paperwork. The second is just to not take on US clients. And that's why I'm sure most people watching will have an experience of being rejected from opening an account somewhere because they are an American. And this is the reason, because international banks don't want to put the time and effort in order to make sure that they are compliant with FATCA. Because just simply saying no to US expats is the easiest and honestly safest option to secure their profits. So the reason that you struggled so much is because of an incentive to try and stop tax evasion. But let's suppose that you are able to open an account somewhere and you are allowed to invest. Well, then the next hurdle that a lot of US expats face is falling foul of what's known as PFIC investment. A company is classified as a PFIC if 75% of its gross income is from non-business operational activities, or it has 50% of its average percentage of assets held for the production of passive income. Now, what's the problem with holding a PFIC? What this means from a tax perspective is that profits aren't taxed as capital gains. That sounds great, but no, they're taxed as income, which is far more costly and often makes it fiscally unviable to invest in PFICs. A US citizen owning a PFIC, whether they're abroad or at home, has to file an IRS form 8621. Mutual funds and ETFs are all classed as PFICs because more than 50% of the assets are held for the production of passive income, as all of the assets within it are smaller companies which are being held for the purpose of passive income, regardless of whether those companies themselves are actually PFICs or not. And the other problem with PFICs is that a company cannot be a PFIC. You can have a company which isn't a PFIC, it has an investment strategy change, perhaps it buys a certain amount of assets which suddenly become more valuable, and then it can change into a PFIC without you realizing. So just getting it right when you first invest in individual companies doesn't necessarily mean you're going to avoid PFIC, or what I like to call the PFIC trap. Just to summarize this, the main reason that US expats outside the US find it so hard to invest locally is because taking them on as clients just isn't worth the risk to international banks. If they fall foul of FATCA legislation, the tax penalties are so large compared to the amount of value that a US expat client represents to them, then it's just not worth the risk. And as such, we've seen more and more of them just say no to pretty much all US expat clients. And even if you do get past that step, you can fall foul of investing in PFICs, making your investment proposition very tax inefficient, which will really hamper your long-term gains and growth potential.